Hello guys, hope you guys are doing fine. Hope you've taken your vaccination amidst this time of pandemic. Please make sure that you stay fit because you will be able to sit into the examination only if you're fit. So now with all the goodies done, so let us get down to business. So here we are today to start our session with respect to paper 7, your direct tax laws and your international tax laws. Now this paper is supposed to be one of the voluminous papers of your entire CA final examination. So what we are going to do is we are going to go through each and every chapter that is relevant to you in detail, along with problems that will be solved for relevant topics or questions that will be answered for relevant topics and MCQs that will be handled. So this is not some sort of a fast track batch or a revision batch or fast track classes or revision classes. This will be a regular class. We will go into details of each and every chapter, and we will be solving problems from the institute material, from past RTPs, MTPs, and also from past papers. Okay, so everything will be done through these recorded videos, and you can reach out to me with the number that is given in the YouTube link, and you can always come back to me with doubts on the Telegram channel that is also given in the link. And then what is expected out of you? I expect each and every one of you who is watching this video to make sure that you don't run through any part of it. You watch the entire video, and each video, wherever I feel is necessary, will have notes given as part of the YouTube video. So you will have the notes with you and you can watch the video along with the notes. Now, after we finish a couple of classes, I will be giving you handouts which will have questions from the past exams, RTPs, MTPs, as I had told you before, and then we will be solving it in a video as well. Now, apart from this, what I expect out of you is whenever you have doubts, you please reach out to me, and make sure that when we do problems or when we have solutions that are being solved in these videos, you follow them verbatim, because we are trying to make sure that whatever we produce as answers are going to be exam class and they are not going to fall short of the expectations of ICAI. Now, interestingly, the breakup, if you see for paper 7, 70% of it is going to be for direct tax and 30% of it is going to be there for international tax. The number of topics, only 8 topics are there as part of international tax for 30 marks, whereas 23 topics are there as part of your direct tax, which is going to take around 70 marks. Now, this direct tax is a topic that you guys should have already been exposed to as part of your intermediate examination or IPCC, as the case may be. And there are a couple of topics which will get repeated for final, but the intensity and the conceptual requirement of these topics will be slightly on the higher side when it comes to final examination. This international taxation is a new paper, new part, and you also have a separate paper, paper 6C, which is an optional paper, which is also covering these topics as part of their international taxation syllabus. Now, one good thing about international tax is that you have only 8 topics and you are going to score 30 marks from that. So the first point that I have to stress upon is that since you have more than twice the topics for more than twice the marks, just twice the marks, so 70 marks is going to be tested for 23 topics, whereas 30 marks is going to come out for 8 topics. So make sure that you put some amount of energy and efforts into these 8 topics so that you're able to squeeze out the best from these 8. Now, let us understand what we are going to do today as a topic which is almost asked in every examination. It is asked in every examination. This topic is part of your international taxation. Since you are already exposed to direct tax to some extent, let us start afresh and then we will take up this topic which is new. This is called as transfer pricing. So what are we going to start off with today? We are going to start off with international taxation. And then the topic that we will be doing is transfer pricing. Okay. Now, this topic is generally tested for 5 to 10 marks. In every examination, you will have a question from this topic. You will definitely have a question from this topic, and also sometimes MCQs are tested from this topic. So sometimes the marking weightage that you expect out of this topic can slightly go up also, but definitely you will get a question from this topic every examination. Okay, it can be part of a numerical problem, or it can be a regular question that you will have to be answering, or it could be pick and choose kind of a problem where they will ask you to tell whether this is a correct statement or not, or probably they'll ask you to substantiate a particular statement, asking whether it is correct or not, and stuff like that. So now, having known what is the expectation of the institute for this particular topic, let us jump into the topic. Now, before I start explaining what is transfer pricing, what are the provisions of transfer pricing, let us understand the history behind this topic as to why this topic even came into play. What was the necessity to bring these provisions into play is an important aspect we need to get answers for. So what we will do is, let us find out the pre-story which resulted in the department giving out these provisions called as transfer pricing provisions. Okay, so now what we are going to do is, we are going to take an example. We are going to take an example and see how these provisions were mandated. Okay, so now there is a company in Singapore. Okay, name of the company is Acer Singapore Pte Limited. There is another company which is situated in India, Acer India Private Limited. Then there is another company in Japan. Okay, this is Acer Japan Corp. So these are the three companies. Now let us understand if there is any relationship between these companies. So Acer Singapore Pte Limited has invested into 85% capital of Acer India Private Limited, which means what? Acer Singapore Pte Limited holds 85% of share capital of Acer India Private Limited. So this gives us the relationship of parent and subsidiary. Now, Acer Singapore Pte Limited also holds 80% capital of Acer Japan Corp. So again there is a parent subsidiary relationship. Okay, so this is the relationship between these three parties. Now, as you guys must be aware, Acer is a very famous laptop and a desktop company. They are into manufacturing of computers. Okay, so Acer Singapore sells laptops. Okay, so this entity Acer Singapore, we will call it ASPL. ASPL, okay, is going to do what? Sell laptops costing rupees 8 crores at rupees 12 crores to Acer India Private Limited. So what are they doing? They are selling laptops which cost 8 crores to Acer India Private Limited at rupees 12 crores. Now, same ASPL, okay, ASPL sells laptops costing rupees 8 crores at rupees 10 crores to Zebronics India Private Limited. So these are two transactions which have originated from the Singapore entity, Acer Singapore Pte Limited. So what have they done? They've sold 8 crores worth of laptops at 1.12 crores for AIPL and 8 crores worth of laptops at 10 crores to Zebronics India Private Limited. Okay, so this is one side of the transaction. Then what has happened? AIPL, the Indian entity, AIPL manufactures laptops, okay, and it sells in the following fashion. So 20% and 80%. It splits the stock manufactured to 20%, 80%. Same laptops, they just split it into two, because these laptops have an active market only in two areas. One in India and two in Japan. Only these two locations have active market for these laptops. Okay, so now what happens? This 20% is sold to, let us say, some TechZap, okay, TechZap India Private Limited at rupees 4 crores. So 20% of the manufactured produce is sold to TechZap India Private Limited, which is an Indian unrelated entity. That entity is not related to AIPL by any way, but they are selling it to that entity at 4 crores. Now, 80% of the produce of AIPL is sold to AJC, that is Acer Japan Corp, at rupees 12 crores. Okay, so this is the entire gamut of transactions that have taken place. Okay, now let us see what is the impact of these transactions. Let us see what is the impact of these transactions. So these transactions, let us break it into two. So one is the purchase transaction, and two is the sale transaction. Correct? Now, when it comes to the purchase transaction, what has happened? 10 crores worth of laptops procured for 12 crores. Correct? What you can purchase from a third party, what you can purchase from an outsider, from a non-related person at 10 crores was purchased at 12 crores from your parent entity, ASPL. Correct? So can also be procured from India, from Indian vendor at 10 crores. Sir, what about customs duty? Forget about customs duty for the time being. Let us focus on getting the conceptual clarity, then we can get into the details. So what can be done by AIPL, the Indian entity, can either purchase from Singapore from an unrelated person, or AIPL can purchase from an Indian vendor at 10 crores. But what has AIPL done? They have purchased from the Singapore entity at 12 crores, goods worth only 10 crores. Okay, so this is the impact of the purchase transaction. Let us keep this aside for the time being. Now, what has happened to the sale transaction? Okay, sale to unrelated person. Sale to unrelated person is 20% of the output, which has been sold at what rate? It has been sold at 4 crores. So if the same sale is to be extrapolated, if the same sale is to be attained, what should be the 100% of the sales? 100% of sales should be 4 crores divided by 20%, which is going to be rupees 20 crores. So the total sales of the 100% produce should be 20 crores. it should be 20 crores. Okay, let us assume that there is no closing stock because they have told that 80% is sold, 20% is sold, so there is no closing stock. So let us keep things simple. So sale has been effected to the extent of 4 crores for 20% of produce, which means what? The entire lot should have been sold for 20 crores. But what has happened? 80% sold to AJC for rupees 12 crores. So total revenue, what is the total revenue? 16 crores. So this is the total revenue generated by AIPL, Acer India Private Limited. Now, to understand this better, what we will do is, let us quickly prepare a profit and loss account. We will prepare a profit and loss account. So actual profit and loss account. Actual profit and loss account. Okay, so what is the total revenue? If you see, the revenue is 16 crores, 4 crores worth of sales towards Texap Private Limited, and 80% being 12 crores worth of revenue towards Acer Japan Corp. So by sales will be 16 crores. Okay, and then two purchases. What have they purchased from? They have purchased from ASPL, that is Acer Singapore Pte Limited. What is the cost of purchase? The cost of purchase is 12 crores. Therefore, to profit. Okay, let us assume that there are no other transactions. Let us not complicate. We'll stop it there. This is the entirety of transaction. To profit is going to be 4 crores. Okay, now tax is always paid on what? Tax is going to be paid on the profit. So taxation, tax payable, we'll call it tax payable, and we will assume for the time being that this company is covered under section 115 BAA. It is covered under 115 BAA. So the effective tax rate will be 25.168%. Under 115 BAA, the effective tax rate is going to be 115 BAA, 25.168. So applying the rate, we are getting 10067200. So the tax payable is 10067200. So 1 crore 67,200 is the tax payable if these transactions were to give life into. Now let us see what should have been the case. So we will prepare should be P&L. What is this should be P&L? There is no such thing called as should be P&L. Had the transaction been executed at their own fair value, what would have been the case? So what will be the sale value? By sales, we have considered 16 crores here, but what should be the actual sales value? 20 crores. Why? Because when we sell to unrelated party, that is the price which we are selling to someone without getting influenced by anything. So buy sales will be 20 crores. And then two purchases. What value should we take here? We should not take 12 crores. Had we purchased from someone in India or had we purchased from someone in Singapore who is not related to us, what will we purchase at? We will purchase only at 10 crores. Okay, therefore to profit will be 10 crores. Okay, now what is the tax payable? Assuming the same 25.168%, what is the tax payable? 2 crores 51 lakhs 68,000. Okay, so 2 crores 51 lakhs 68,000. This is going to be the tax payable. This is what these MNCs kept doing. So what did they do? They influenced the purchase price and they enhanced the cost. Now look at what has happened. Just carefully observe. This should be the realistic picture. Tax payable should be 2.51 crores, whereas the entity has ended up paying only 1 crore, and everything seems to be green from the face of it. Everything seems to be green and correct from the face of it. Okay, so this is what MNC started doing. What did they do? They started influencing the selling price and the purchasing price. Why did they do this? Now, the MNC started migrating into India because the resources were available at a lower rate. The labor availability was at a very low rate, so they wanted to exploit it. On top of it, they found out that India, being a developing country, had a tax issues. That is, they were generally charging higher taxes. For example, Singapore's tax rate is only 17%, whereas India recently only it got converted to 25%. Before that it used to be 34%. 34.904 used to be the highest for corporate taxation. Okay, so now what happened? These MNCs wanted to repatriate their money. That is, they wanted to get back their money without it being taxed. So what did they do? They told boss, you tweak the purchase price. I will tweak the selling price. I will tweak the selling price. What I will do is I will increase the selling price. Okay. And people were like, okay, fine, you can go ahead and do it, because the Indian entity was getting everything it wanted from the foreign entity. They did not question all these transactions. So what happened was, the purchase price was influenced by the foreign entity. Instead of charging 10 crores, they charged 12 crores. So what happened because of this? 2 crores which has to be taxed, or this 2 crores which is no longer a purchase price, got silently repatriated back to USA or Japan or whatever country, be it Singapore, whatever be it. So people started repatriating money without paying tax on the same. Okay, so that this became a problem, because if you generally repatriate otherwise, it will be in the form of dividend, it will be in the form of interest, whatever be it. But here it got repatriated as a business expenditure, which is allowed as an expenditure for the company which is claiming it. So AIPL will simply tell in its return of income that purchases 10 crores. No income tax officer used to question this. Okay, so it was a very happy life for the MNCs, and they started exploiting both purchases and sales, and they started making money out of this by evading tax. Okay, they called it tax planning. Now, beyond a point, it became very obvious. Lot of people started complaining. These MNCs are making good money. These MNCs are making good money, but the local players started losing out. And this was causing a question of concern. Okay, so this is not part of taxation. Let us go to the other side of the story. The income tax department started looking out to the income tax returns. Okay, there were only, let us take for example, there are only 10 companies which have turnover greater than 10 crores. There are only 10 companies which have turnovers greater than 10 crores. And AIPL is one such company. And all these 10 companies are into the business of manufacturing laptops. Okay. So there are 10 companies in India who are into the business of manufacturing laptops, and only these 10 companies have turnover greater than 10 crores. Rest of them are below that. Now, these 10 companies are always the hornet's nest for the purpose of income tax department. They'll always want to make sure that the tax revenue is properly getting collected from these 10 companies. Okay, so when they do the analysis, they find out the following: 9 companies. Okay, 9 companies. Before that, what is the profit percentage of this particular company? So profit percentage is 25%. Okay, so profit percentage is 25%, and here it is okay. So 9 companies are showing a profit percentage of 50%. Okay, which is what we have here. 10 by 20. Profit by sales is 50% for 9 companies. Okay, because they are operating within the normal threshold. But one company alone seems to show this issue. 4 by 16, 25%. So AIPL alone had a profit percentage of 25%. Now, the income tax department started taking various returns of this particular assessee. They wanted to check whether this is a one-time activity or if it has repeatedly happened. Every year it is 25%. Now it was a matter of concern. See, if there is a 2%, 3% gap, or even max to max 5% gap, it is acceptable. But 25% gap between 9 companies and 1 company is not acceptable. They knew that something was not correct. So they started looking at past 5 years return. Every year this issue was there. Every year the profit percentage was 25%. Now they wanted to find out what went wrong. Before we do get into this analysis, why do you think the department wants to do this? Because tax loss to the government, how much is it? This is 2 crores 51 lakhs 68,000 minus, what is this, 1 crore 67,200. This is the tax loss to the government, which is how much? 1 crore 51 lakhs 00800. This is the loss that the government is incurring every year. This is not normal loss, this is the tax loss. The tax payable has been under accounted or underpaid to the extent of 1.51 crores by this one company. So the government started losing out. So the revenue wanted to find out, the department wanted to find out where things were not working out. So they took past 5 years return, every year 25%. Now they wanted to find out what is going wrong, why is this happening. They started calling out for the assessment. They gave the notice. They told, please submit your financial statements. So ITR 6 financial statements, still they call for financial statements because the actual classification and details and notes to accounts generally give better visibility to the assessing officers. So they ask for financial statements. So the financial statements were perused through. Then they found out the purchases was overvalued. So what was supposed to be 10 crores was 12 crores. And then revenue was supposed to be 20 crores. And then it was actually only 16 crores. This was giving a lot of suspicion to the income tax department. What they did was they called for the list of debtors. They asked for the list of debtors. When they took the list of debtors, they found this one main party, list of creditors and debtors. They called for both list of creditors and debtors. And the two main parties that they found was ASPL and AJC. Okay. Then they immediately moved into the shareholders information. There they found that this fellow was the main shareholder, parent. Then they found out, okay, owing to the close connection or relationship between two parties, the transaction has been manipulated. So this requires a reassessment. Reassessment meaning not the reassessment that you know from assessment procedure. This particular transaction requires to be reassessed. That's it. That is the reassessment that I am talking about, not 147, 148. So what did they tell? Because of the close association between two people, this transaction seems to have happened. Otherwise, this is not possible for this transaction to happen. What have they done? They have fudged the transaction. Okay, they have influenced the transaction. So this transaction requires some sort of analysis and it has to be rebuilt again. So this was covered by section 92. Section 92 up to the year 2001. Up to the year 2001, this is what used to happen. So assessing officer used to call for the assessment. He used to find out that this is the problem. Because of this problem, the transaction seems to be wrong. So we now have to go ahead and check whether this transaction is right or not. So this sort of an exercise was carried out by the assessing officer every year up to 2001. So he had to be satisfied that there was something wrong owing to the close connection between two enterprises. So price was fudged. This was what assessing officer had to know up to 2001. Then in Finance Bill 2001, they made an amendment. They told, boss, doing the research work, finding out, then trying to call the assessee, then trying to rework, all this won't work out. Instead of keeping the responsibility on the income tax department, let us push it to the assessee. Now the assessee has to do a study, find out if transfer pricing provisions are applicable to him and do the reporting. We will check what he has done and see whether he has complied or not. What was the initial state? Whether transfer pricing as a provision is going to be applicable or not, the assessing officer had to do the entire work. Okay, no submission, no certification was made available. There was section 92 which got replaced in the year 2001, effective 1/4/2002, where what they did, they introduced chapter 10. Okay, chapter 10 with amendments of section 92 to 92F. They introduced these sections 92 to 92F. These sections covered the provisions of transfer pricing. These sections covered the provisions of transfer pricing. Okay, so now that the department had understood that assessees, owing to the close nature or close relationship or the integral nature of one with other, there is an influence in the price that is being charged by one assessee to another assessee. This is causing in tax loss to the government. So this was enacted for what purpose? To protect the interest of revenue. Protect the interest of revenue. So the entire provisions that we are going to study under this topic is to do what? To make sure that the country does not lose revenue because of such transactions. Okay, so therefore the main focus is going to be on saving tax loss, because of certain transactions which are controlled by multinational companies. Okay, so now they wanted to give some clarity on these provisions. So what did they tell? They told, boss, see, this new provisions of section 92 has three major important points which we need to focus upon. Okay, point number 1. Okay, what is that? There has to be international transactions. So the first emphasis was that there has to be an international transaction. Okay, then the second emphasis was that between associated enterprises. So what did they tell? There has to be an international transaction. Such international transactions should be between associated enterprises, and then such transactions should be at arm's length. So what were the three conditions? There had to be an international transaction. Such international transaction should be between associated enterprises, and 3, these two elements, when they exist, then the transaction should be at arm's length. Okay, so now this raises a question which we have to answer. Okay, what is the meaning of international transaction? What is the meaning of associated enterprises? Okay, and then what is the meaning of arm's length? So the new provisions which were enacted had sections which answered each of these questions. So it had sections which answered each of these questions. So this was answered by section 92B. This was answered by section 92A. And this was arm's length was answered by section 92C. Okay, so our focus today will be towards understanding the provisions of section 92A and 92B. The next session we will go into understanding 92C. Okay, now before knowing what is an international transaction, we should first understand what is associated enterprises. Why? Only associated enterprises based international transaction require our understanding towards arm's length pricing. Suppose there is an import transaction or an export transaction. Both parties are not related. Still they are called as international transactions. Correct? So first understand what are associated enterprises. Then there has to be an international transaction between these associated enterprises. Then such transaction should be at arm's length. So that is the chronological order in which we are supposed to understand the provisions of this topic. So let us start off with provisions of section 92A. Now the section 92A tried to define and give instances which would constitute an associated enterprise relationship between two or more parties. It gave instances where there would be two or more parties who would share the relationship of associated enterprises. Now, let us try to understand one by one with the example which we started this session with: Acer India, Acer Japan, Acer Singapore. We'll use that and understand these relationships. Okay. Now, what was the starting point? If you go back to the way we started this issue, we told that Acer Singapore holds 80%, 85% in Acer India, which means what? Parent subsidiary relationship. So under Companies Act, what do we call this? We call this exercise of control. So there is a control of one entity over the other, therefore they are related parties. Fine. Now Acer India went and told Acer Singapore, boss, our income tax department is coming and kicking us. They are asking us to pay tax for the excess price which we have paid to you. We have paid price to you, we are paying tax also to them. This and all is not going to work out. We had a good life till now, but now they are penalizing us. Please tell us what to do. Now the Singapore entity has taken the help of some lawyers, and then they have come to the following consensus. What they are telling is, we will buy back the shares, or you divest it. What we will do is, we will reduce our holding. Let us not get into the nitty-gritties of Companies Act right now. Let us reduce the holdings. We will reduce the holdings from 85% to 35%. So what will ASPL do? ASPL holding 85% will reduce the holding to 35%. Now, is there a control of holding subsidiary relationship here? No, there is no holding subsidiary, because beyond 50% only holding subsidiary relationship will come into play. What has happened right now? ASPL has reduced its shareholding from 85% to 35%. Now, again they enter into the same transaction, and then the same price of 12 crores is being charged, and these fellows are also selling to Japan at 12 crores instead of 16 crores. And then they are again showing 25% worth of net profit margin. The income tax department is now again annoyed. Last year only we told them, we enacted some amendment also, still these fellows are showing only 25%. What is wrong? They went in, they started checking out everything, and then they saw whether the parent company is still doing this. Then they found out that parent company is not doing this, because there is no more parent in the name of ASPL. Then the department understood one thing. Why have they not divested further? Why have they stopped it with 35%? Because as per Companies Act, if I am to pass a special resolution, I will need votes in favor thrice as that of votes against. So which means what? For a special resolution, I will need 75% acceptance and 25% only can reject. If this exists, only a special resolution can be passed. Correct? So by holding 35%, ASPL has made sure that not a single special resolution can be passed by AIPL without the blessing of ASPL. So by holding shares at a percentage which will make sure that special resolution cannot be passed, they are trying to control the other enterprise. Correct? They are trying to control the other enterprise. So the department came with the next amendment. What was that? One enterprise, if holds 26% or more of share capital of other enterprise, then both are AEs, associated enterprises. So what are they trying to tell? This is ASPL, okay, and this is AIPL. ASPL holds 35%. Holds how much? 35% of capital. So what are these two? These two are associated enterprises. So if there is any transaction between these two parties, one being in Singapore, one being in India, and they are associated enterprises, the transaction will be an international transaction. Why, we will see after we come to section 92B. Therefore this requires some sort of investigation under section 92. So what was the first definition of an associated enterprise? When one enterprise holds 26% or more. Don't wait for 51. Start from 26, so that we will know that share capital is not used as a base for control. Okay, so that will make sure that these two are associated enterprises. Now they did not stop there. They did not stop the amendment there, because our fellows did not play with purchase alone. They played with sales also. So what did they tell? One enterprise holds 26% or more in two enterprises, then both such enterprises are AEs. So what is the meaning of this? Now ASPL, AIPL, and then AJC. Okay, so ASPL holds 35% here, and here they did not reduce. Here they started holding the same 80%. Here they hold 80%. Here they hold 35%. Now what the law tries to tell is that there is a control that is established on AIPL by making sure that special resolution cannot be passed without ASPL. And ASPL also controls AJC by holding 80%. Now if ASPL is going to tell AJC something and ASPL is going to tell AIPL something, both are bound to listen and follow. Why? Because of the relationship ASPL shares with these two entities. Therefore these two entities are associated enterprises. We know that ASPL, AIPL associated, ASPL, AJC associated. A parallel to B, yes. A parallel to C, yes. Therefore B parallel to C. So this is what has happened here. So that is why AIPL and AJC are now associated enterprises. Okay, so this was the second point. So the first point was one enterprise holding 26% or more in the other enterprise will make both these enterprises as associated enterprise. One enterprise holding 26% or more in two different enterprises, then those two enterprises will be called as associated enterprises. Okay. Now what happened after this is that they wanted to make sure the same mistake doesn't happen. So they went back to the Singapore entity, and the Singapore entity made a different step this time. What they told was, fine, reduce capital to 12%. So they held only 12%. Okay, and they told instead we will appoint 5 directors. Okay, AIPL has 7 directors, of which 5 directors are appointed by ASPL. Okay. Now on top of this, what did ASPL do? In AJC, one executive director was appointed by ASPL. Now what has happened? They decided that control is not working out. Instead what they did, they wanted to play with management. Okay, so a company is fully managed only by the directors, board of directors, or the executive director, namely the managing director. Okay, so what they wanted to do was they wanted to take control via management route. The control that they initially tried to take was through what route? Through shares. It failed. So what they did, they wanted to take control via management route. So what they did, they started appointing more than half of the board of directors, or they tried to appoint one executive director. Again the same 10 crores worth at 12 crores, 20 crores at 16 crores. This issue happened. Again department went through, they found out 25%, then they went into the shareholding pattern. Everything seemed to be fine. because 12% was only the shareholding. Then they got annoyed. They told, please give us the annual report. In the annual report, you get to have the directors report as well. Okay, then they saw the list of directors. Okay, and they told, these directors seem to be new. Why come they are new? Then these fellows told that, see, these directors were appointed by ASPL. Then they found out, okay, so this is the new method that those fellows have come up with. The ASPL Singapore entity has now found out a new loophole. What is that? They wanted to play around with management. Let us take care of that loophole as well. So law brought in the next point. What was that? One enterprise appoints more than half of the board of directors or one executive director of the other enterprise, then both are AEs. So what did they tell? If more than half of the board of directors or at least one executive director or more is being appointed by one person in another person, both these persons are associated. Consequently, if one enterprise appoints greater than half of board or one ED of both enterprises, AJC as well as AIPL, then both such enterprises are AEs. So what will happen? In this case, AIPL's more than half the board is appointed by ASPL, and for AJC one executive director is appointed by ASPL. So what will happen in this case? Both AJC and AIPL will still continue to be associated enterprises. The sale of 16 lakhs will be under scrutiny of transfer pricing, and the purchase of 16 crores will be under the scrutiny of transfer pricing. Purchase of 12 crores will be under the scrutiny of transfer pricing. Sir, where from you are telling 16 crores and 12 crores? I am just continuing with this example that we had here. 10 crores purchase made at 12 crores, 20 crores sales made at 16 crores. So that is what I am trying to continue here. Okay, so these were the 2 points that were considered. Now these 2 points were taken from management point of view. How to take control by means of having control over the management. The control was emphasized or exercised by the Singapore entity via management by means of directors. The initial 2 points that we saw was control being exercised by having shares in the company. Okay, now we are going to go into the next point. Now again, what has happened? These fellows have rushed to the Singapore entity and they have told that, boss, we tried your method. We have also taken up the board for reconsideration. The entire list of directors have been reshuffled and you only made the appointment. Now the department tells that we are trying to have a control over the management. Therefore, they will go ahead and charge the transfer pricing provisions on us. So we are now going to pay extra tax just because we dealt with you. This is not going to work out. Please do something. Then they are telling, fine, you go ahead, you make the appointments of directors, we will not interfere henceforth. Let the shareholding also stay at 12%. Okay, so it is a smooth sale as of now. But we will do one other thing. What we will do is, I will give you a loan. And you just take the loan for the purpose of business. Okay, and these fellows also accept. So what has the foreign entity, Singapore entity, done? They have given a loan to the Indian entity so that they will be able to use it for their business purposes. This is what has been done by the Singapore entity. And then again the transaction has been done at 10 crores instead of 12 crores instead of 10 crores, and 16 crores instead of 20 crores. Again, the income tax department has got annoyed. They've called back and they found out that these fellows have still maintained the 25% profit rate. Now they want to find out what went wrong this time. Share capital is fine. They called for the annual report. Board of directors are also fine. Everything seems fine, but suddenly they notice something. In non-current liabilities, okay, under long-term loans, they had 10 crores last year. That is, this was, let us say, last year, and this is current year in the balance sheet. Okay, so 10 crores was there under the last year, and current year it has become 100 crores. Current year it has become 100 crores. And then when they check the total assets is 150 crores. The department is shocked. They are asking, boss, why did you take such a huge loan? You have taken 90 crores worth of loan. What is the point of taking such a loan? They are telling, no sir, we have taken the loan from ASPL because we need it for the purpose of working capital, and also we are incurring some R&D expenses for new models to be produced. So we have taken this loan. Then they have understood. Just because the loan has been granted by the ASPL entity, they are now trying to exercise control over the Indian entity. What have they done? They have given a loan, and then they have controlled the Indian entity towards influencing the price. Okay, so now department told, boss, you have taken a loan, I agree with you, but still there is a control factor present here, because of which the price is getting influenced. Just because he gave loans, you are forced to sell it to him and purchase from him at a certain specified rate. Therefore, we will not agree with you. Please reverse back whatever purchases you have shown as 12 crores, show it only as 10 crores. Sales must be accounted for at 20 crores. Pay additional tax of 1.5 crores. So what was the amendment that was made? What was the additional point that was made? Where borrowings of 51% or more of total assets of other enterprise is made by another enterprise of one enterprise and another enterprise, of one enterprise made by another enterprise, both shall be AE, both shall be associated enterprises. So what is the condition? You cannot tell simply by giving 5% loan of the total assets and call it as associated enterprises. More than 51% of the assets are controlled by the loan given by you. Therefore, you are now trying to control the other enterprise, is what the department tried to infer. Therefore, they told, nothing doing, please go back and consider what the original P&L that should be there, should be P&L that should be made available. Now, this became an issue, and then they rushed back to the foreign company, their ASPL, and then they told the story. Then ASPL decided to take back the loan, okay, and instead what they did, they went and told AIPL to go ahead and take a loan of additional 10 crores. They asked them to take a loan of additional 10 crores. This 90 crores loan which they gave, they took back, and the loans came back to 10 crores. They told, you go do one thing, take additional loan of 10 crores. Okay, these guys went and took a loan of 10 crores. Okay, what they did was, and they told, after taking 20 crores worth of loan, what did ASPL tell? You take additional 10 crores worth of loan, and after taking that loan, you give us a loan of 20 crores. Okay, so what happened? The loan was taken at the rate of 20 crores. Okay, and then they had to give a loan of 20 crores. Then these fellows, AIPL told, no, nothing doing, we cannot give you a loan and all. It will be a serious issue. If you want, you do one thing, you take the loan. ASPL, please take the loan. What we will do is we will give you a guarantee. Okay, and then ASPL also was thinking for some time, and then it told, fine, we'll go with your plan. What we will do is we'll take a loan of 10 crores and then you give us a guarantee for 10 crores. Okay, and then after long discussions, then they came back telling ASPL was a bit skeptical about this issue, and they told, nothing doing. What we will do is you take the loan. You take a loan of another 10 crores. Okay, and we'll give you a guarantee. You will sit by us so that we will be able to help you out with your trading transactions. And then these fellows finally had to agree, because they were an ex-parent company and they are also controlling them. They had no other choice, so they went ahead and accepted. Now what has happened? They have taken fresh loan of 10 crores. Who? AIPL has taken fresh loan of 10 crores and ASPL has given guarantee for the entire loan of 20 crores. Okay. Now they have gone ahead and purchased at 12 crores. They have sold at 16 crores in total. Department is again angry. They come back and then these fellows are telling, sir, we don't have anything, sir. Even our loans are perfect. Now we have taken only 10 crores additional loan for the current year. Department is like, okay, fine, give me the details of the loan. And then they have come to find out that there is a corporate guarantee that has been given. By ASPL to AIPL. They are asking, why have they given you a guarantee? Sir, because our credit policy, our credit rating is low, so we required someone who was very rich to come and give us guarantee. Only then the loans would be sanctioned. And then these stories were not selling to the income tax department. Then they started analyzing the transaction. They found out that these fellows are controlling, the ASPL entity is controlling the Indian entity by giving guarantee. By giving them a benefit, you are trying to take away their independence. Therefore, this becomes again a question of control. So they made the next provision. What was that? Where 10% or more of the borrowings are guaranteed by the other enterprise. So where 10% or more of the borrowings of the other enterprise, borrowings are guaranteed by the other enterprise, is going to be called as what? It is going to be called as associated enterprises. Both these enterprises will be called as associated enterprises. Now, this again became an issue. They couldn't do business, they had to pay tax. Now what they told? The Singapore entity told, fine, we'll do one thing. You produce the product which we are selling to you. We are actually selling a particular laptop to you. Instead of purchasing the laptop from us, you make the laptop in India. But what we will do is, we'll give you the technological know-how for it. Okay. And the know-how will be priced, and the raw materials for the purpose of manufacturing this product, we will give it to you. So what did they tell? You manufacture the laptop which we are giving it to you right now. But we will do two things. We will give you the technological know-how. And we will also produce the raw materials. We will also provide the raw materials. So after doing this, the raw material cost that they had incurred is now coming to them at the same 12 crores. Initially the finished product was coming at 12 crores. Now the raw materials started coming to them at 12 crores. Okay. And then the finished product which they used to sell at 20 crores instead of 16 crores, now they are selling the finished product which they are producing at the same 16 crores. Ultimately, the picture remained to be the same. Initially, they were selling a much higher advanced version of the laptops. Now they are selling a lower version of the laptops, but still the same profit was maintained, same revenue was earned, same cost was incurred. Now this became a headache. The income tax department started again reviewing the balance sheet, because these fellows will always do something and make it apparent on the balance sheet. So when they reviewed, they made two changes. Change number 1, where know-how, patent, copyright, trademark of one enterprise is the dependent factor of the business of other enterprise. So what are we trying to tell? Then both are AEs. So there are certain intangible assets. When these intangible assets are the base assets with which we are going to carry on the business is impossible without these intangibles. Okay, so where these assets are kept as the base for the purpose of carrying on business, then these two enterprises are going to be called as associated enterprise, because without the intangible of the other enterprise you cannot run the business. So without ASPL's know-how, AIPL cannot manufacture. Therefore there is a degree of control that is being established by ASPL over AIPL. Okay, so that was the next point that was introduced. On top of that, where 90% or more of raw material of one enterprise is provided by the other enterprise. So what happened here? Entire raw material requirement of AIPL was provided by ASPL. So which became what? 100% of raw material requirement of one enterprise was given by the other enterprise. So which means what? AIPL was completely dependent on ASPL for raw materials. That is why ASPL was able to manipulate the prices. Okay, therefore these 2 points became the next point of control, where they told that associated enterprises relationship does exist. So kindly reverse the transactions which are overstated and understated and restate the transactions correctly and pay taxes. Okay, so this is what was the next 2 points that was introduced. Now what happened next was, they told fine, we will not interfere with the purchases, you do the purchases wherever you want. Okay, but sales I would suggest that you sell it to AJC. Sales I would suggest that you sell it to AJC, and when you sell it, make sure that you sell it only at 12 crores. When you sell it, make sure you sell it only at 12 crores. Now let us take an example. I want to buy a car. Okay, I go to the showroom and I give them a check for 3 lakhs. I give them a check for 3 lakhs and I tell them, please give me the latest model of BMW. Will they give me or will they throw me out? They will definitely throw me out, because in any transaction of purchase, the price cannot be dictated by the buyer. The price can be dictated only by the seller. Seller is the one who fixes the price. So in this case, what has happened? AIPL had to sell to AJC, but the price was fixed by ASPL. The price was fixed by ASPL, and ASPL is the parent of AJC. Okay, therefore, where the price is fixed by the buyer, both buyer and seller are AEs. So where the price is dictated by the buyer, then the buyer and seller are supposed to be associated enterprises. Now after all these hangama, they wanted to stay away from all these problems. So what they did, ASPL and AIPL. Okay. Here there is Mr. A, who is a director, who is a shareholder, and here again Mr. A is a shareholder in AIPL as well. He holds 30% in ASPL and 25% in AIPL. Mrs. A holds 22% in ASPL, and in AIPL Mrs. A holds 28%. Now what has happened? These two together, Mr. A and Mrs. A together, have been controlling these two entities. These two together have been controlling these two entities. So now what they did, they started exercising the same 10 lakhs in place of 12 crores in place of 10 crores and 20 crores in place of 16 crores story again. Now this became a problem. Department found out everything, but now when they started looking into the shareholding pattern, something new emerged. Suddenly two shareholders, individual shareholders, were holding more than 50% and controlling the enterprise. Okay. They asked who are they, then they told that, sir, they are the promoters, sir, so they are holding more than 50% share capital here. Okay. Now what has happened? Then the department found out that control is established because the same individuals are holding more than 50% in both these companies. Same persons are holding more than 50% in both these companies. Therefore, where an individual and his relative together control both such enterprise, then both enterprises are AEs. Okay. On top of that, they also brought in one more point. What was that? Member of HUF and relative of such member control both enterprises by shareholding, then both are AEs. So what did they tell? Where an individual and his relative together hold more than 50% in two enterprises separately, then both these enterprises will constitute an associated enterprise. Likewise, where a member of HUF or his relative has held more than 50% in both these enterprises, then both these enterprises shall constitute associated enterprise. Okay, suppose one enterprise, for example AIPL, let us take AIPL because that is our prime party, Indian party in concern. AIPL holds 10% share in another enterprise, 10% share in another enterprise being partnership firm or AOP or BOI. So they also brought in this kind of a relationship. Instead of having two companies, where one company was going to have a share, profit share in a partnership firm or in an AOP or BOI, that would also constitute what is called as associated enterprises. Then finally, any other relationship of mutual interest as prescribed. So there can be any other mutual interest of any other relationship of mutual interest as may be prescribed. Okay, so these are the various points when it comes to associated enterprises definition. So what are they? First two points are based on shares held, 26% or more, one entity over the other entity, associated enterprises. One entity in two such entities, then the other two entities are also considered as associated enterprises. Then one entity has the rights to appoint more than half of the board of directors of the other entity or one executive director of the other entity. These two are considered as associated enterprises. Same way, one trying to appoint more than half of board of directors or one ED or more in two such enterprises, both enterprises will be constituted as associated enterprises. Then the next point that we saw was with respect to loans. Greater than 51% of the total assets are given as loans by one enterprise to another enterprise, both are considered as associated enterprises. Then where one enterprise tries to guarantee more than 10% of borrowings of the other enterprise, those two enterprises will be constituting as associated enterprises. Please remember, for borrowings point, it is 51% of total assets. When it comes to guaranteed more than 10% of borrowings, so please be careful on 10% and 51% on what. Okay. Now, one thing before we proceed further to the remaining points, when I talk about shares 26%, please remember it is only shares carrying voting rights. Shares carrying voting rights or participating rights, which is going to be only equity shares. Sir, participative preference shares? No. No preference shares will be eligible for the purpose of definition of associated enterprises. It should be equity shares only. Okay. Now, the next point that we saw was with respect to your know-how copyright patent which is being used by another enterprise of the first enterprise, then they are considered to be associated enterprises. More than 90% of raw materials being purchased by one enterprise from another enterprise, both these enterprises are to be treated as associated enterprises. Then we also saw that where one individual tries to control both these enterprises will be treated as associated enterprises. Where a transaction of purchase, the buyer dictates the price, then the transaction, the parties involved will be considered as associated enterprises. Then per individual or his family members, individual or his relatives together hold more than 50% in both these enterprises, they are considered to be associated enterprises. Likewise, member of HUF and his family relatives holding 51% or more in both these enterprises, they are considered to be associated enterprises. One enterprise holding 10% share in another partnership firm, AOP, BOI, then this partnership firm and company are considered to be associated enterprise. Any other mutual interest is also to be considered as, relationship of mutual interest is to be considered as associated enterprises. Okay. Sir, should we know these relationships by heart? You don't have to by heart. Just remember what we have discussed so far. Just listen to it again. You will get the grip of what are the various points that are involved. Now, if you see these points, they are divided in three main brackets. First bracket is the share capital. That is the 26% point which we have seen. The second point that we have seen is the director's point. So, capital and management. The rest, all other points are covered under the control aspect. Okay, but all three, if you see, are towards control, because one entity trying to control the other, or one trying to control two or more entities. So the theme or the base is control, but it is established via three different mechanisms. That's all. Okay, so with this we have completely understood the provisions or discussed the provisions of section 92A. So now we know what is the meaning of associated enterprises, what are the conditions or what are the situations when there would be associated enterprise relationship between two parties. Now, the next area of study will be section 92B. What is that? International transaction. So for international transaction, what should be there? One resident and one non-resident. If there is a transaction, this is going to be an international transaction. Now, one non-resident and another non-resident. Okay, can there be a transaction like this? If there is a transaction like this, this is again an international transaction, because section 92B says that at least one party has to be non-resident. Therefore, when there is a transaction between two non-residents, again it will be subject to transfer pricing study. Therefore, when it is between two residents, then there is no question of transfer pricing there. So there is no question of transfer pricing there. Sir, specified domestic transactions, we are not yet there. When we come to that aspect, we will discuss, because right now the definition that we are trying to address is what? International transaction. Okay. So when can non-resident to non-resident happen? When one of the non-residents have income that is taxable in India, when there is an income taxability in India, because the income would have accrued or arise in India, or deemed to accrue or arise in India, concept would have gotten triggered. Therefore, the transaction between these two parties would also be subject to transfer pricing study. Okay, so now this is the international transaction. Now, what did we tell? The international transaction should be there between a resident and non-resident, or non-resident and non-resident, but this is only defining the international part of it. What is the transaction that is allowed? What are the transactions that are allowed? First transaction, sale of tangible property or lease of tangible property or purchase of tangible property. It can be anything. So if AIPL is going to purchase laptops, laptop is a tangible property, correct? So this laptop purchase by AIPL from ASPL. ASPL is in Singapore, AIPL is in India, non-resident, resident, and then tangible property purchase, it is an international transaction. ASPL holds 65% in AIPL, for example, then there is going to be a parent subsidiary relationship, associated enterprise. So they are associated enterprise. The transactions that they have carried out right now is an international transaction. Therefore, provisions of transfer pricing will apply to find out the arm's length price. Okay, So this is the first type of transaction. Suppose ASPL sends out 1000 laptops. It leases it out to the Indian entity. It tells that you can take this laptop on lease for 4 years. Okay, you just have to pay lease rental to me. Still the transaction will be within the purview of international transaction, and since they are associated enterprises already, you will have to take them into transfer pricing study. Now, if they purchase from the Indian entity, still it is under transfer pricing provisions. Okay, now, so the first one is going to be tangible property. Second one, sale stroke purchase stroke lease of intangibles. Like we had discussed under one of the points, where the know-how, patent, copyright, trademark is being transferred by ASPL to AIPL. What does this constitute? It constitutes transfer of intangible property, because they are all intangibles under the income tax classification, or even for that matter Companies Act classifies it as intangibles. Now these intangibles is transferred from Singapore to India, non-resident to resident, therefore it is an international transaction. Since there is an associated enterprise relationship between ASPL and AIPL, this transaction will be subject to transfer pricing study. Therefore we will have to check whether they are at arm's length. This is the second transaction. Now financing. ASPL gives loans to AIPL. ASPL tries to give corporate guarantee to AIPL. So these are what transactions of financing by one entity to another entity. This is also between a non-resident and a resident. Therefore it is an international transaction. This non-resident and resident are associated enterprises under section 92A. Therefore it will be subject to transfer pricing study. So what are the three transactions that we have seen? Tangible property, intangible property, sale, purchase, lease. On top of that, the next one is financing activity. Now, services. Now, ASPL provides after sales services to AIPL. Okay, these are services rendered by one entity to another. One entity is situated in Singapore, other entity is situated, recipient entity is situated in India. Therefore, these transactions will be classified as international transactions. Okay. Now, on top of that, what else do we have? Cost sharing. What is this cost sharing? Let us take, for example, ASPL is working on a type of laptop where you will have 3 sticks. You will have 3 sticks and a keyboard. This stick, you would have seen it in James Bond movies probably. These sticks will try to project the monitor on any flat surface. You don't have to buy a monitor. You'll just have to buy these sticks which have the processor and the display from them. And you have a keyboard which is attached via Bluetooth to these 3 sticks. Okay, you place the 3 sticks, keep the keyboard, and if you just press one of the buttons, it is going to display on the screen, and you can work using the laptop and the mouse that is given along with it. Keyboard and mouse that is given along with it. This is the prototype that ASPL is trying to work on. Okay, it takes 7 years and they finally have come out with a successful model. Now for these 7 years they would have incurred extensive cost in doing some research to arrive at this product. And instantly this product gains extreme popularity and everyone in the world wants this. Okay, but these fellows want to milk out the money, so what they are doing is they are selling only to their related parties, who ASPL. So first what they are doing is they are selling one lot to AIPL, one lot to AJC, and when they sell, what are they doing? They are telling that, boss, I have incurred 1000 crores. I have incurred 1000 crores worth of research cost. 1000 crores worth of research cost. Okay, what I am going to do is 40% of it I am going to give it to you, because you are taking 40% of my production for sales, so you should also take 40% of the cost. So he is pushing 40% of the cost. Whether this 40% which he is pushing, is it correct or not, that the department will want to find out. What is the basis? Whether it is going to be headcount, whether it is going to be sales, what is the rationale for using such a huge percentage is what department will want to find out. Since this cost sharing is done by non-resident to resident, and this is called as international transaction, and since this is between parties who are related to one another, it is an international transaction between associated enterprises. Therefore, this will be subject to transfer pricing study. So these are the international transactions, or the scope of international transactions. Now, let us take one case here. Now, ASPL, then AIPL. And let us take, for example, Zebronics India Private Limited. Okay. Now, this entity is holding 65%. ASPL is holding 65% in AIPL. Therefore, these two are associated enterprises. Now, this is a third party, unrelated party. Unrelated party. Now, ASPL enters into a contract with ZIPL. Okay, ASPL enters into a contract with ZIPL. What are they telling? You sell to AIPL at 80% of selling price to others. So what is he telling? He is telling that to ZIPL, he is telling that you sell to AIPL at 80% of the cost that you, 80% of the selling price that you charge to others. So ASPL is telling ZIPL to sell to AIPL at 80% of the price which he charges to others. Now, what happens? This transaction gets executed. So at 80% only it gets sold. Okay. Why is ZIPL listening? Is he related? No, he is not related. Why is he listening? Because of his regular mutual relationship that they share. Because he is a regular customer. ZIPL is a regular customer of ASPL. Due to their relationship, what they are doing, they accept that they will charge at a lower rate. Now, will ASPL do this to anyone and everyone? No. He will do it only to his related party. ASPL will not ask ZIPL to sell it to the entire customers all over the world. He'll ask ZIPL to do it only to his customers. Therefore, this transaction is a deemed international transaction. Why deemed international? Because without ASPL's influence, this transaction would not have been possible at all. ASPL has tried to influence the transaction via third party, so that when the department looks at it, it will look as if it is a clean transaction. But no, it is an indirectly influenced transaction. Though the transaction has originated in India and completed in India, it will still partake the character of an international transaction. Therefore, it is called as deemed international transaction. So it is called as what? Deemed international transaction. Okay. So with this, we have completed our understanding into what is associated enterprise and what are international transactions. So quickly let us revise what we have understood. Section 92, which starts to be the charging section for transfer pricing, says that there are three components which are primary and pivotal for the purpose of transfer pricing study. Number one, the transaction has to be between associated enterprises. Then number two, the transaction has to be an international transaction. Number three, the transaction should be at arm's length. Okay, the transaction should be between an international transaction, has been defined under section 92B. So what are international transactions? Transactions where at least one party is a non-resident is called as international transaction. Whether both parties can be non-resident? Yes, there can be two parties who are non-residents. What are the transactions that are generally covered within the ambit of section 92B? It can be sale, purchase, lease of tangible property, sale, purchase, lease of intangible property. It can be financing, it can be services, it can also be cost sharing between enterprises, which will be classified as international transactions. Okay, now The next aspect which we saw was with respect to section 92A. What did we see as part of 92A? 92A defined various scenarios of what is called as associated enterprises. So the first two scenarios were covered under the capital scenario with 26% shareholding as the base, and telling that where 26% or more shareholding of one enterprise and another, or one enterprise in two others, is considered as associated enterprises. Then the second base classification was management, where more than half of the board of directors or one executive directors of one or both such enterprises appointed by one enterprise, then these enterprises are called as associated enterprises. Then 51% or more of borrowings, 10% or more of 51% of more of borrowings borrowings amounting to 51% or more of total assets were considered as associated enterprises. Given by one to another, both are associated enterprises. Corporate guarantee or guarantee given by one enterprise to another enterprise which is greater than 10% of the loans of the other enterprise, both such enterprises will be considered as associated enterprises. Then business of one enterprise is based out of the intangible property issued by the other enterprise, then both such enterprise will be treated as associated enterprises. Where the purchases, 90% of the purchases of one enterprise is from the other enterprise, then both enterprises are supposed to be associated enterprises. Where in a transaction the buyer influences the price and not the seller, in such transaction both the parties are considered to be associated enterprises. Then the next point was where one individual and his relative together control two enterprises, and both such enterprises are supposed to be associated enterprises. Where a member of HUF or the relative of such member of HUF together control both such enterprises, then both such enterprises will be associated enterprises. Now please understand, an individual alone need not hold 50%. Individual and his relative together shall hold more than 50%. Likewise, and HUF, member of HUF and his relative together shall hold more than 50%. Only then control will get established. Okay, so this is what we have seen. And then one enterprise holding 10% of profit share of the other enterprise, both such enterprises shall be considered as associated enterprises. Okay, so this brings us to the conclusion of understanding section 92A. One additional point that we have seen is that where the transaction between two unrelated parties where a transaction between two unrelated parties are influenced by one associated enterprise, being the associated enterprise of one of the unrelated parties, then the transaction shall be deemed international transactions. Okay, so this is what we have seen with respect to section 92A and 92B. So get an understanding into this. I have shared the PDF where I have tried to give you synopsis of all these points. Just go through these points. Keep it steady in your mind. Don't worry about getting an in-depth understanding right away, because as we get into section 92C, we will be trying to understand how arm's length pricing works, and then the combined understanding of these three provisions will be better at that point in time. And from the next class, we'll probably have one or two problems also, so that the practical side of how things work will also be understood. Since this is an introductory session, I have not dwelt much into the problems, and I have also shared a list of PDF, not a list of PDF, I have shared a PDF which has a list of transactions where I would like you to make an attempt and find out whether they are classified as associated enterprises or not. You can reach out to me over the WhatsApp number or the Telegram channel with your solutions or doubts if any in this case. Okay, thanks a lot guys. So it was a good session. So please feel free to comment and make sure that you ask your doubts to me on a timely basis. We can connect on the next session. Thank you.